Welcome to Energy Frontiers, everyone. Now, the disruption in Libya's oil production and exports announced by the country's Eastern-based administration on August 26th sent shockwaves through the global energy markets. As a major producer of nearly 2 million barrels of crude per day, the North African country's absence has contributed to the already volatile geopolitical tensions in the Middle East. I am joined now by Amena Bakr, a senior research analyst at Energy Intelligence Group, to get her perspective on the unfolding scenario in Libya. It's great to see you again, Amena. But what's really going on in Libya right now?
Thank you, Justina. Always a pleasure being with you here. Let's start from the beginning and see what happened. As we all know, that Libya is divided between two governments. You have the government in the east, in Benghazi, and that's dominated by General Haftar, and the government in Tripoli, which is recognized by the UN. What happened is that the Tripoli government tried to replace the central bank governor, which was aligned with the government in Benghazi. And that caused the government in the east to say that they reject this decision and will impose a force majeure on all oil fields, impacting production and exports. Now, this announcement, of course, as you mentioned, caused shockwaves in the oil markets, and we saw oil prices spike by around 7% the day it was announced. It was on Monday. Following that, things kind of calmed down from there. We see oil prices now going down again into the 70s zone. They were previously at 80, as macroeconomic worries are again putting pressure on prices.
So how long do you anticipate that these disruptions to Libya's oil production will last?
Okay, now the size of the disruption itself, what we found out is that so far, all the oil export terminals in Libya have not been impacted. And in fact, all the ledgers showing the vessels coming in are still, active. So the force majeure hasn't impacted the exports yet. If indeed imposed at the rate that they were speaking at, we're talking around 630,000 barrels that could be impacted in terms of exports. Now, in terms of production, we know that the Sharara field, this has been shut down from the beginning. This is not a new shutdown. And its capacity is 260,000 barrels a day. And you have the Elephant field, which is shut down, which is 80,000. So right now, the shutdown and production in Libya is around 340,000. Potentially, it could be a lot more because under the Benghazi government in the east, these are where most of the oil fields are. So if they decide to shut down, the majority of that 1 million barrel per day production of Libya could be hit.
Now, 30,000, that's a lot. Now, is Libya such a crucial player in the oil industry? And how is the situation in that country likely to impact prices moving forward? And how are investors reacting to this?
Any supply disruption, of course, causes shockwaves in the market, but we've seen that kind of ease off. Initially, it was that reaction of, from the market where oil prices, we saw that rise in 80, but today, it seems like a calmer situation with more information coming out that it hasn't been impacting the exports yet. Justina, I just like to note that we're in a market that is also oversupplied to some extent. It's not like in 2011 where we had a situation, Libya's production was also impacted in 2011 and you had other countries stepping in. I remember at the time Saudi Arabia had a special blend. Libya's crude is quite sweet and light, so it's a kind of special grade that is not really available in the market. So there needed to be a special blend by Saudi Arabia to compensate that. So if we do have some volumes, the market already is kind of well supplied, and that's why we're seeing OPEC impose such deep cuts. I don't think there will be that rush to put back barrels into the market. But if in case there is a need, potentially, lighter sweet crudes could come from South Sudan, but they're kind of inconsistent with their production. So I wouldn't say that they're completely reliable in replacing. Definitely not the full amount. And some can come from Iran, and potentially some from Saudi Arabia again. If we do get some kind of shock, or some of these exports are impacted from Libya, Iranian barrels are possible. A possible blend from Saudi Arabia, a special blend, that's also possible. Some Iranian crude also possible. It all depends on the size, but no single country could really replace that volume of this specific grade from Libya.
From Libya. Now, what's your outlook for oil prices in the near term, even as big international banks such as Morgan Stanley and Goldman Sachs are revising their forecast downward?
Yeah, we see oil staying in the kind of mid-70s for at the moment. I mean, the macro concerns are really weighing into the market. A lot of uncertainty around Chinese demand. Supply growth for this year at Energy Intelligence, we expect supply growth to be around 1.2 million barrels a day. And that's kind of very short of what OPEC expects. OPEC's expectation is still above 2 million barrels a day of growth. So, we have prices in the kind of mid-70s zone. And we do see, to some extent, I mean, OPEC does plan to bring some of its supply by the end of the third quarter, beginning of the fourth quarter, easing some of the cuts. We see that happening. But going into 2025, we do see a softer market, which means that they might need to pause these increments. All depends on the market situation.
Right. Amena Bakr, Senior Research Analyst at Energy Intelligence Group. We thank you for your insights into this developing situation in Libya and its impact on the global markets. Thank you so much, everyone, for watching. Bye for now.